Here's what no one's saying out loud right now. You should not buy a house.
Say what?
Wait, what? A mortgage podcast telling you not to buy a house?
That's right, Manly. And it's because buying a house is not the same as buying a home. A house is just math, right? It's just rates, payments, square footage. But buying a home, that's a whole different animal. You're buying something now with meaning. There's real substance behind it. And that's what this podcast is today. Once you understand the why behind buying a home, then buying a house is going to be a complete different experience.
And here's the shocker. Right now is the best time in hundreds of years to buy a home, but the worst time to just buy a house. Because math shifts week to week, but your why, that's permanent.
Welcome to the Mortgage 101 podcast with Anthony and Manly. Hey folks, welcome back to the Mortgage 101 podcast with Anthony and me, Manly. And today we got a special guest host, our good friend, Kyle Draper.
Woo-woo.
He's here to talk about rethink everything you know about social media. Today, he's helping us rethink home ownership. Man, this is what we're talking about. He's all the way from Dallas. We're having a great time. Flew him in just for this event. Can't wait.
Man, I'm a big fan of a little Kyle Draper action. That is 100% facts. But here's what we're covering today. What we should be focusing on, which is we shouldn't just be buying houses right now, right? We should be buying homes. And there's a big difference. You know, there's math, but there's also why and how the Fed's rate is shifting. And the stance is pushing rates lower. And why defining your why first is going to matter more than ever, especially right now. And we're also going to tackle the intimidating mortgage buzzwords, the 101 rate tracker, and, you know, there's going to be a lot of stuff packed into this episode.
And I think that's why I'm here. Just like social media isn't about likes, home ownership isn't about math. It's about connection, clarity, and your why.
Hopefully you like all the education that you're getting from Manly and I. Do us a favor and smash that like button, subscribe and follow, and tell all your friends and family about us.
All right, folks. Everyone has a why. Family, freedom, stability, wealth. But most never define it. And when you don't, the market defines it for you.
Yeah, and that's how people buy houses right now. It's based off of math and math only. The math says, yeah, you can afford it. Everything looks good. It adds up. But math doesn't comfort you when the roof leaks or the rates move. But your why does. It gives you that passion to push through, to stay uncomfortable. And right now, people need to be uncomfortable to get that success. And that's the people who are winning right now.
That's right. When you define your why first, everything else makes sense. Without a why, the math feels like chains. With a why, the math becomes your defender.
It's, you know, Manly and I talk about this all the time. And, you know, we get so stuck on looking at the math, right? Because the math needs to make sense, right? We need to make sure we're making stuff happen on an economic level, but we have to also understand our why, right? We gotta define our why, which right now we're having to rethink our why because it's changing, especially in this landscape. And nothing's better than having a good old fashioned, come to Jesus moment with yourself to say like, hey, what am I doing? Why am I doing? So that way I understand how I'm doing it. That's
right.
where rethinking how we're getting prepared for home ownership really helps us understand what that future is going to look like.
Yep, for sure. That's why we got Kyle here, and going back to how we met Kyle and the rethink everything and social media, and all the books and all the stuff that he's written that are the Rethink series. This brings us into what we're talking about now, and we do talk about let the math tell you what to do, but you also need to understand your why. Otherwise, the math is just math. All right, guys. House versus home. Let's make this real. Two buyers, both approved for $400,000 loan. Same lender, same rate, same math.
Yeah, one buys the house, one buys the home. One has a why, one doesn't. They see the payment and say, yeah, we could swing this, but there's no bigger purpose. I mean, every expense feels like punishment. The house is just math. And that's a much harder hill to climb when you don't have that why behind you And I think that's the main focal point of this podcast, is really defining that why, right?
But then we've got buyer two. They buy a home. Their why is clear, maybe family stability or wealth building, and they actually stretch into a payment that's 20% higher. On paper, scarier.
Yeah.
But with a why, they give 100% more of themselves. And here's the key. That higher payment is temporary. Rates are falling, the Fed is softening, refinancing is on the horizon, but the value of living in alignment with your why, that's permanent.
Yeah, hey,
Facts.
with a house, you wait for the math to get better. With a home, you act because the why is bigger than the numbers. And when the rates fall, that 20% higher payment is replaced with 20% more equity, 20% more appreciation, 20% more value. You never get that waiting on math. All right, folks, why the math alone will betray you. Right now, the math pencil's out, right?
I'm going to make this pencil disappear. Ta-da! It's gone.
Rates are in their lowest in nearly years. Affordability is improving. The Fed has shifted its tone, but buying just because the math works is the most dangerous move you can make.
That's right, Manly. And because math won't carry you alone, math can't tell you if this home is your destination. Only your why can do that. And, that's right now people are asking, what is my why? What is my motivation? What is the muscle behind the push? Only you know that why. Only you know what's really pushing you to feel that uncomfortableness, right? Of those extra costs, or, not having that extra money at the end of the month, but just knowing that home ownership is like a physical piggy bank. It's like the gift that keeps on giving in multiple ways that rent just will not do for you.
And in my world, it's the same way with social media. Metrics are math. Why is meaning. Wrong why makes the right math meaningless. The right way makes hard math worth it.
All right, so what do? We got to get the practical path forward. Here's how we move you forward. Before you shop, define your why. Write it down.
Yeah, then test the math, right, against the why. If your why is stability, pick a fixed rate. If it's wealth, buy for equity growth. Let the math defend your why, not define it. It also helps you understand what you're trying to achieve. A lot of people come to me and they go, I really don't care about my payment. I just want to have a better lifestyle. That's probably going to be someone who wants an ARM or who wants a variable. Whereas someone who says, I don't like surprises. I want to make sure that I have stability. That's a fixed rate. That's maybe a 40-year term where that amortization stretched. They're paying the same interest as a 30, but now they got a third less payment, so they have more stability. So you really have to understand what your why is, so that way people like, Manly, myself, we can really understand that why to prepare you for home ownership.
And Anthony, let's not forget, don't buy a house that fits a spreadsheet. Buy a home that fits your why.
Give us a little example of that. Like what for you, if you're buying a new home today, like, and you're trying to grow your family, what's important to you right now for your family? You have young kids and stuff, and what like, if you're putting your home ownership shoes on right now, you're trying to do something for your family. What does that why look like for you?
Well, for me as a happily married man, it is asking my wife, what are all the non-negotiables that she wants in that next house? And at that point, price doesn't really matter as much, right?
Yeah.
If I can pay a little bit more than we would want to pay, but all those things are there, right? So for my wife, it's a big kitchen because she enjoys entertaining.
Yeah.
It's a big yard because she grew up in the country. And so in Dallas-Fort Worth, it's harder to find that type of opportunity, but that would get us so much further than just literally crunching the numbers and being like, here's what we can afford. And then we do buy that house, and my wife doesn't like it, right? She's counting the days to get out of it. And, my life is probably not better because of it.
Probably not. I mean, that's kind of what we're talking about, is taking that moment to take it a little farther maybe and have that conversation with your family and understand what's going on.
And that's rare too, because, what Kyle just stated, Manly and I, we see it on a daily basis. we'll see that division of two different Ys, right? You
Yeah.
got one side of the aisle that the Y is pure math. And then you got the other side of the aisle where it's pure Y, right? And it really
creative.
gives you an overview of where their perception is, right? You got, whether it's the both of them that are working professionals, their why is really math. Whereas you got one who's focused on the family, one who's focused on the economics. One's got math on their hands and one's got why. And so you just made a great point, Kyle. If you're looking to purchase a house and you're not purchasing solo, make sure that the whys are in tandem, because then you can come to the table and realize, oh my gosh, we have complete different perceptions here, and it's going to potentially be a miss for one of us. And so you got to get on the table for that, because how many times we see that, like, oh, this is too big. No, this is too small. Or, hey, this is perfect location. No, it's not close proximity to the freeway. So you just made a really good point there, Kyle.
Got to find that balancing act, right? With the true why, the numbers, all of it. That's what we're talking about. I mean, we're not talking about being silly and shooting the mark way over your budget. Trying to determine what your budget is and your why, and make those two things converge.
That's it.
If you guys are liking all the information you're getting from us, if you're feeling that we're educating you, please smash that like button, subscribe, DM us with any thoughts or ideas for our show, and also tell your friends and family about it. Hey, we're going to take a quick look at the economic snapshot here. Here's where the market stands. The 30-year fixed rates are averaging about 6.56%, lowest in 10 months. Pending home sales are up 1.6% year over year. And the Feds, their language, it's softening. A cut this fall is likely.
Yeah, it's definitely likely. And so this is the moment, right, to define the why. Before the math shifts again, because it's going to shift. If you wait until after you close, you just missed a chance, and now you're in that boat that you really don't want to be in. So make sure you define it ahead of time. And then as these shifts happen, they're going to come and go like waves. And so you can't make those waves define your destination. Your why has to define it. And that's what we're looking at here.
All right, you guys, ever popular buzzword time with Ryan. He's doing the rethink drill.
Buzzword drill time. 5 intimidating mortgage words buyers hate hearing. Let's rethink them. First off today, we have loan level price adjustments, LLPAs.
Yeah, that's not just like a food additive that was, banned by the FDA. That is basically, it's a risk adjustment, right? It's par for the course, because we know that there's always going to be changes, not just on a Y level or not just on an aesthetic level, but on a math level. So these loan level price adjustments just are going to set the market up for as least amount of volatility and risk as possible. And so as the market swifts and changes, we'll see these loan level price adjustments change as well. Credit score minimum, down payment minimum. There's a lot of variables that come into LLPAs.
All right. Second term for today is adjustable rate mortgages, better known as ARM.
All right, guys, that's fixed for a set period of time, and then it adjusts thereafter. Usually has a 30-year amortization. So a typical one is like a 5-year ARM, fixed for the first 5 years, amortized over 30 years, and then it adjusts every year thereafter till the end.
Why should we do ARM now, Manley?
Well, an ARM right now may or may not be a lower rate than your 30-year fixed. The gap has to actually make sense. If the gap is not big enough, then the risk is not worth the squeeze.
When you're saying gap, is that like a clothesline? What are we talking about gap?
The gap between the 30-year fixed rate and the gap between, say, the 5-year ARM. If it's 6.5% on the 30-year fixed and the 5-year ARM is at 6.25%, the gap is too small. Why would you do that? Why would you take that risk? If the 30-year fixed is 6.5% and the ARM is at 5.5%, that's a full point. Now it makes sense. Let's take that risk.
All right. Kyle, welcome to the buzzwords. Your first term is debt to income ratio, DTI.
Well, I've been around the industry enough to know that this is simply balance, right? It's the percentage of income toward debt. Lower equals more freedom, right? And I'll let you guys kind of handle the details of this.
Yeah, debt to income ratio. How much is coming in? How much is going out, right? It's like a real life balance sheet or a P&L statement. Here's the revenue, here's the expenses, and you got two, debt to income ratios. You got the front end and the back end. So the front end is just your house payment. How much is your house payment? PITI, principal, interest, taxes, and insurance. The back end ratio is your house payment plus discretionary debt, credit card payments, installment loans, autos, student loans. We don't take your water or we don't take your Netflix subscription, but the discretionary debt tells the story of, are you too leveraged on debt or are you in a perfect balance?
All right, Anthony, going back to you for this one. Points are just referring to as discount points.
So points are, us slimy lenders' way of making money. All points go to us lenders. It doesn't go to anything else. It goes to our boats. It goes to our extracurricular activity. It really just goes to whatever we want because we run this shit. I'm sorry. That was the mindset of a lot of borrowers. They think that is actually true. What is actually true is us lenders, our commission cannot be based off of the rate, cannot be based off of the program. And it's the volume that we close in. This is not 2007. So points are based off of the rate, meaning you have a par, meaning no cost for that rate. You can choose to buy it down under the market rate, and that's going to cost points. And that's where Manley and I come in to go, does this make sense? Do we want to buy this rate down? And what's the break-even rate? How much are we paying versus how much are we saving? And then what does the front view look like? Meaning, are we going to refinance in 2 years? Is it going to make sense to buy all that down only to get that same rate in 2 years for free? And how much is it costing? So we want to make sure that, hey, if we're spending $5,000 to buy that rate down, are we going to make that up in 12 to 24 months? Because that's when we see an opportunity for refinance. If it's like 5-6 years, we're leaving money on the table. So points, discount points, that's a very good question to ask your lender to say, what does the math look like here? Am I making economic sense or am I just throwing money out the window?
All right, Manley, you're going to bring us home today with our final term, escrow.
Ooh, escrow. Escrow is where we're going to set money aside for homeowners insurance and for property taxes. We're basically going to take the total annual bill and divide it by 12, and we're going to take a 1 month look at that. So if we got a $900 annual payment for your homeowners insurance, we're going to end up with $75 a month that we're going to put on into your escrow savings account so that when the bill is due, all the money is going to be available for you to pay it. Same with your property taxes, same thought process. We're going to take 1/12 of your overall annual bill. We're going to set that money aside one payment at a time so the money's available to make the payments.
I like
Wait.
this segment. Y'all are teaching me stuff.
I thought that was a snail.
Jack, I stood up for you. Everything went wrong after that. They strapped me to a cannon.
Wait, what?
I thought, didn't you just say escargot or did you say escrow?
No, I love me some escargot, baby. I love me some snails with that good old garlic butter dripping on your bread, puts a little snail in the shell. Hey.
So what you're saying, Kyle, is no matter if we're talking about escargot or escrow, it gives us clarity, right? It makes us rethink
That's right.
everything. Hopefully you like all the education that you're getting from Manley and I. Do us a favor and smash that like button, subscribe and follow, and tell all your friends and family about us.
All right, guys, it's time for the ever popular mortgage rate tracker. We're going to talk about what's happening with fixed rates so far this year in 2025. Anthony's going to spell it out for us where we started and where we're ending up.
Yeah. So obviously, our average, we're thinking 6.15, right? We're thinking we're going to be in the low sixes by the end of the year. Let's take a look and see how this is panning out. January started out at 6.65. It was up. Fed stayed tough on inflation. Going to February, we dropped to 6.55, basically flat. Go to March, we're at 6.25. Now we're talking. We're cooking with what Manley always says, peanut oil, because it was down. The treasuries dipped. And then we went to 6.20. Again, flat like a crystal clear lake. But then we ticked up in June, right? The bond sell-off. There's some insolvency. There's some fear in the runway because of inflation. But then July, we really see, a tick up because the bonds sell off again. But then inflation cooled in August. We went back down to 6.4. September, we went to 6.56. Again, it's kind of flat, kind of like, a little bit bumpy, but nothing too crazy. I'm really thinking this last quarter that we're going to see, especially with the Fed's cut, that's definitely happening. It's not an if, it's a when. We're going to see some clear waters, and we're seeing it right now. Like literally, this is the lowest we've seen in a year. I mean, it is. We are seeing these mortgage backed securities get pushed up in a way that we can now. I mean, I'm locking in the upper fives for VA, lower sixes for FHA and conventional. We are well on our way to seeing those 5.5 million people who are waiting for a 5 to be in front of that rate to get off the sidelines. That is going to be a turning point in our economy and in this market.
Yeah. We're hoping, buddy. Hey, rates are bouncing all over, but they're still staying in the mid sixes. Volatility rules are still in play. You only win if you're prepared.
And so y'all have heard it from us all episode long. Don't wait for perfect math. It doesn't exist, but your why, it lasts.
All right. That wraps up episode 21 of the Mortgage 101 podcast. Huge thanks to Kyle Draper for being a guest host on us with us today and helping us rethink home ownership. Love it. Thanks for making it all the way here from Dallas, buddy.
Absolutely. Thanks for having me.
Yeah.
Yeah, and if this episode made you stop and think about your why, do us a favor. Hit that like button, follow, subscribe, so you never miss Kyle wearing that big, beautiful blue hat. That's what I say.
And, guys, as the social media guy on the episode today, share this with a friend, right? Don't let a friend buy a house. Help them buy a home.
If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.
Hey, Kyle.
Hey, Anthony.
Knock, knock.
No, wait. We got rid of this on the show. We're not doing knock-knock jokes anymore, Anthony.
Yes, we are.
Come on.
Am I supposed to say it?
If you feel like it.
Who's there?
Rethink.
Is this a rethink who?
Rethink your why before you ever buy a house.
God.
Oh, brother, this guy stinks!
Oh,
That is
God.
terrible.
That is terrible, dude. But Daddy's lender knows best. Hey, folks, thanks so much for watching the Mortgage 101 podcast with Anthony and Manley and our special guest host, Kyle. We're going to be sending out these books to you if you follow a few minor instructions. Kyle, what are the instructions?
All they've got to do is like the episode, subscribe to the podcast, and then leave a comment about your why. Why did you buy your house? Why do you want to buy the next house? We want to know. And then you'll get a copy of my first book that I ever wrote, Rethink Everything You Know About Social Media. If you're in sales, if you're in marketing, if you're a small business owner, you need this as a part of your playbook. And it'll be signed.
Yeah, absolutely. Love it. Thanks so much for coming, Kyle. Hopefully you guys like our show. Hopefully you're finding value in it. Thank you so much, Anthony from Hawaii. Appreciate you coming on, and appreciate you all. If you guys are liking all the information you're getting from us, if you're feeling that we're educating you, please smash that like button, subscribe, DM us with any thoughts or ideas for our show, and also tell your friends and family about it.